Hello guys, glad to have you on board again today, Wednesday usual podcast, and we're starting a new series today to terminate the one we've made previously. Like we've been dealing with bubbles, then we've been dealing with ranges, and now we're going to complete this series with the trends. Um, so just like we were doing previously, we're going to keep on using the same structure. So it's going to be a three session of video in which first one is going to be talking about technicals, the second one is talking about psychological applications of those things, what biases might be at play and influence your judgment into those contexts. And last but not least, the philosophical way of doing things. It's not necessarily the least important one, so it's just so you know. In this third podcast, we're basically like trying to broaden our vision on the topics of trends or whatever, but still reintegrating the previous knowledge that has been spread out in the previous podcast, so you can basically create connections and solidify the knowledge. It's really helping a lot in memorizing whatever has been said previously. So it's not like you can listen to podcast number 1 and 2 and you skip the third one. Like, it really has an interest. It's not dealing new information, but helping consolidating the knowledge previously acquired. So anyway, let's get it started with the first one. Obviously, that's the most important one. I need your full attention on this one. Most of the knowledge in here is obviously normally already known by many of you guys. I'm just gonna not say over again what you already know. So the goal today is to say that normally you should have read the PDF manual at that stage, so you should be familiar with the indicators, or at least the way they represent stuff, because I'm not gonna go down this road. You must also be familiar with the words themselves, like what is a pullback, what is an accumulation, stuff like that. I'm just going to try giving you more of a structural understanding of how trends build themselves. So I don't really like to say understanding, because more than anything else, the first warning in here is absolutely necessary. What I'm going to be sharing with you guys today certainly don't explain market behaviors. It's just that it gives a structure and a strategy called behavior on how to deal with trends into market contexts. So it's not explaining. Sometimes these structures simply won't work, but statistically speaking, they do work way more than they fail, and that reason gives you a statistical advantage of using this knowledge instead of not using it and randomly getting in and out. So anyway, so we've been talking about ranges, and you know that trend is generally what people are talking the most about. Like when you get to when you first encounter with the markets, you're generally going to hear about the usual stuff like trend is your friend, the Dow theory, higher lows and higher highs means an upward trend, stuff like that. So let me just cut to the chase immediately. This is all just crap. So the trend is your friend obviously is a big gamer into trading and stuff like that. We're going to go down this one again later in the podcast, but first of all, these things that we teach to beginners is the worst they should ever be taught, because actually trading is not about understanding trends. And my personal way of teaching trading is I always teach you how to navigate ranges first, because navigating range is going to help you like a lot to really navigate trends the way you should do this. I'm going to give you a quick example right in here. I started trading in these eras, in this era in here. And for example, I remember those years like they were yesterday. And basically, yeah, I heard and I listened to the same old bullshit I was just talking about. Like, trend is your friend, try to trade the trend, don't try to go anywhere against that trend or stuff like that. So I was basically, okay, this is a bullish trend. I'm gonna just ride that shit, whatever. So of course, what have I done? But the market up. The reality is that when you follow those guidelines, everyone has the same experience. We all bought the fucking market up. So why is that? How is that even possible? Is because trend is your friend actually is a true thing. It is actually, but why do we always take it the worst possible way. So I remember, obviously, I bought the market top, but I was confident. Like when this thing happened, I was like, all right, no worries. This is no big deal. This is just a market pullback. I don't see any reason to get the hell out. And then this shows up. It's brutal, and I was like, oh, damn it, I bought the market top. I think a recession might be showing up again. And the problem is, at that stage, what you do is that you take information from the outside world, and you basically see perma-bearish guys standing on the network saying, all right, this is the end of the world, this is not going to work, we failed, and we're going to build a major higher low point, a major lower high point, and in that perspective, man, the crash that's going to follow is going to be enormous, and you start to doubt, and at that point, what do? You sell at the lows. So obviously doing quite the opposite of what should be done, because lack of experience. So trend following, whatever shit that is certainly not the way you should start at trading. That's not even to say the worst possible beginning of trading, and ranges are. I know this isn't the way you would expect it to be, but ranges are easy to navigate. Ranges rules are easy. The problem with ranges is how you deal with them personally, because this is the problem. Ranging structures are easy to learn, fairly more difficult to apply, because a lot of psychological biases will be at play, but managing those biases are way easier than navigating the one through trends. Obviously, I'll teach you the one about trends on the next podcast, but like I said previously on the podcast number 2 of ranges, actually, it doesn't take that much to dampen your psychological assessment into ranges. It's just a few bits of habits that you're going to have to learn so you don't get impacted into range and don't bullshit trade like many people do. So now that you supposedly navigate range, because I take for accountants that what we're going to be talking about today requires you to master ranges. You don't learn how to navigate trend if you don't master ranges. So normally what I'm going to be saying today requires that you already master ranges. If you're just having a look at this podcast because you like to listen to my voice or whatever the fuck that is, then make sure that you don't. You really need to master ranges first, and only once you do, then you can get to move to trends. So, trends your friend? Yes, obviously, but that's not the type of thing you might be learning. It's certainly not the way to begin into trading to learn trend, but most likely quite the opposite, learning ranges, and then and only then we get to navigate ranges, to navigate trends. So trends, the first question we might ask in here, it was just a quick introduction right before. So now we get into the actual subject. Why do we have trends in the market? Why do we have such a thing? It's simply that markets, in the easiest way we can explain them, are supply and demand. So we have an asset in front of us. Some people are asking to buy it. Some people are asking out. And there is a value to define the exchange price of these transactions, pure and simple. And that's what you have on your charts. And therefore, why do we have trends? Simply because humans are behind these decisions. There are more and more robots, but in any way, those robots are meant to manage human-related type of lifestyle, because when we put those robots in action is to bring up money, and that money is used to buy and sell some goods and stuff like that. So it's all human-related, and therefore there is a lot of psychology in here. But there is not just about it. It's also about economy. And you know the economy is not something to be stationary, though the economy is always evolving, and therefore market prices should be evolving accordingly, because it's the combination of economical behaviors and human behaviors that makes markets most explanatory way of moving. And therefore what could be a trend in this beautiful explanation, what market could be, then it can be two things. Either there is a strong single directional move, like the economy is fairly moving into one direction and is not hesitating. So we can signify that. So trends in prices can come from, for example, in stock market, which are linked to economy, is a fairly improving economy with a good stance. and with a solid pace. And in that perspective, yeah, obviously, economy being improving means stock market will be bullish. But there is still a second part of it, psychology. And this is why we don't go straight line from trends. Otherwise, we would say, all right, the economy is there. We expect that in 2 years it's going to be there. So here's the pace at which we should rise prices. That's not how it works. Prices always oscillate because there is a human factor in here. Humans are not perfect, and therefore we're going to oscillate. Oscillation comes from the perceptions of ranges. Remember what we've said out of ranges. Range is a temporary movement of indecision. It's the purest expression of indecision, doubt, whatever. When we have some second thoughts, we generally range for a bit. And no one never knows for sure, so that's the reason why most of the market structures are ranges, but sometimes these ranges can orchestrate throughout a trend. So a trend is not a single straight line, it's always underlying ranging structures and different time frames. So figure this thing out as being a very complex, multi-layered stuff. It oscillates because sub-layers will get to mature. Some of the underlying trends will mature and we'll have to build ranges. Remember that the structure, the global market structure, is a trend followed by a range, followed by a trend, followed by a range, and sometime a bigger range that will reverse that trend to consolidate on a higher time frame, whatever. The most complex but beautiful way to explain that would be the Elliot wave theory. But the problem is Elliot wave is more than a theory. It's somehow a cult. Some people tend to believe that Elliot wave is explaining the market structure. And whenever you go down this road, you know what the problem is. It generally is a psychological issue. If you try to understand the market, to put them into boxes, to put the whole thing into a box, you're never going to make it. Never, ever, because that's not meant to be. What we can do is take the market and put some portions of the market into tiny little boxes in which we can try to profit for a defined period of time and for a certain structure with a risk management and stuff like that. I'll go down this road later, obviously. So trends are generally an unbalanced moment in which forces are unequal, in which you've got bullish and bearish forces, and one of them will significantly increase its power over the others. All right? So if we sum up the core information, we've got a constant evolving economy. We got some unbalance between bullish and bearish pressures coming from likely human psychology, all right? Then there is also, adding on top of this, speculation and hesitation. The market never knows where to go, so it sometimes and most of the time has the ranges to range, to show some areas of interest. And then there is a multi-layered time frame scale of stuff. We've got short-term investors, long-term investors, and both will behave differently. Both will use different structures, but both will try to ride trends on their local time frame. An intraday trader will try to profit from intraday trends, and will have to navigate ranges accordingly. But long-term traders will basically don't give a shit about the short-term trends and the short-term trending movement, but will try to profit from the longer ones. But anyway, both are actually doing the same job. If you are a trend follower, then trend following is generally explained in a very easy manner. Dow theory, if you've got high lows and stuff like that, just follow the trend and stuff like that. That's the worst thing to do, because how can you really differentiate a trend and a range? You can't hardly do that. So most of the trend followers become breakout traders, and most of the breakout traders are trading breakouts in ranges, and therefore they're very less profitable than other traders. Not to say some of them are just losing because they've got negative long-term rewards out of their strategies. So today we're going to try explaining how to get to the breakout, because the breakout is the technical structure, the most important structural elements of trend. A trend emerges from a breakout, the moment where the bullish and bearish balance starts to unbalance and stuff like that. So the breakout is the core element of trends, but how can you differentiate a trend breakout than a range breakout is today's big topic. Let's get it started though. So just a quick summary, you're supposed to know the structures by now. So normally, structurally speaking and statistically speaking, most of trends tend to orchestrate following a structure. This structure is generally a mature ranges proceeding, all right? Then we start to get the accumulation trade, all right? and we get the breakout trade. All right, normally the breakout is no more than just an accumulation, which is a shorter term range accumulating on the trend channel and then breaking up. Generally, your breaking cycle at that stage, normally the market doesn't stop at the target but keeps on pushing further, generally retraces a bit to this target and then pushes to divergence. All right, generally afterwards comes a pullback, and finally the final excess and then over. This is a typical structure in which we move from area A, that we call point A, to point B. All right, we're moving from this area to this new area, and the intermediate structure has been a trend in which the breakout is generally the moment we're getting out of the point A area to get to point B area. Okay, so that's how you orchestrate a trend. And as you do know this structure, like I said, it doesn't explain the market. It's simply giving you a structure to follow with a decent statistical odd. So now how do we navigate this, and how do we know that this, the breakout, is a true breakout? Because in a range, you will have a breakout in here, and this one will not exceed its target and will reverse. All right, so multiple breakouts, and most of the time people tend to use chart structures like triangles, wedges, whatever, and they use this as a reference point for breakout trading. Most of the time they end up dealing with those structures in ranges, which means they're taking range trades breakout, which are far more dangerous, because in ranges the breakouts are fairly uncertain, and as you get in, you're certainly not, you are generally not certain to be filled as a target, and your stop loss can very well be taken down, because breakouts in ranges can be freakingly trappy. At least the success rate is really slowing and getting to eventually even negative rewards if you're really a bad breakout trader. So trend breakouts is fine, but you need to assess a structure. So in the structure, we've got mature range, accumulation, and breakout. So by just understanding that, you understand that if you want a valid breakout, make sure that it's preceded by an accumulation, and that accumulation is preceded by a mature range. Oh, what the fuck? Then you understand that to be a breakout trader, you need to be a good range manager as well, because actually just what I said is explaining a lot. You need to be preceded by an accumulation. An accumulation is no more than a range in a shorter time frame. So once again, it's talking to me about fucking ranges. I want to understand trends. So you really get to the point. You need to master ranges first in order to truly and navigate the trends the right way. And then the guy adds up on this and he says, preceding this accumulation so-called thing, then he needs to have a mature range. What the fuck is a mature range then? If you really don't know about that, then like I said, you really don't have to look that video, because you really need to master ranges first. So basically a breakout is going to be having significant chances of being valid if you see a short-term range maturing preceding it, rejecting on the trend channel, and this thing preceded itself by a bigger time frame range. That's how things goes. As the breakout goes, the trend settles itself, but the trend is not a straight line point A to point B. At some point we'll have exhaustion and pullbacks, and we're going to talk about the pullback later. So let's focus on how do we exit from point A, getting to the breakout into a very likely breakout structure. The type of structure that you can follow. It doesn't work 100% of times. Sometimes you will have fake breakouts in any way, even if the structures were very favorable for a breakout. Things never going to be predictable. So how do we find the accumulation trade preceding the breakout? Generally, like I said, it's going to be a shorter time range. So let's focus on what a range is. You know the rules. The range is generally the market oscillating between the contexts, all right? And in here, and that's voluntarily, on my charts, you've got two contexts in the same time, which means that the trend channel is no less than the context of the lower time frame. So you can see what happens in the lower time frame. If I've done this thing, giving you two channels instead of one, is not just to be stupidly making things overcomplicated. It's simply that you need to have that multi-layered vision of markets, and this is the easiest way to get it. And if you don't have the indicators, once again, no magic. These things are not absolutely necessary. These things are just the replication of natural processes that you can do manually. These things are no more than trend channels, so you can create those trend channels. The only difference in here is that they have an acceleration factor, so some of the rules might be a little bit different, and we're going to make a podcast about this in the future, explaining how different this can be. But first of all, we terminate this structure with trends, and then we're going to do a specific podcast on how to use my strategy rules and stuff like that without the indicators. Anyway, so these trend channels and context channels are just multi-layering your visions of markets. You know what happens in the bigger picture, and you know what happens in the current market picture. So how do we navigate range? As long as you see prices oscillating within the trend channels, you know that there is a likely range going on. All right, so in here could have been a range, but all right, that's it. Afterwards, generally, like I teach you these two sets of waves, here we got two sets of waves, but you haven't retraced the context in here. So here is a specific case of market in which obviously there was a lot going on in here, but typically we should have hadn't gone there in here. So if we followed a typical guideline, we would have done something like that, and that would have been the perfect way of doing things. All right? Going from context to context, maturing the range, therefore major low, first range boundary, second range boundary, you don't trade this thing. In here comes your first tradable activity, third range boundary in context and stuff like that. But in here we didn't go that low. There was some monetary support already back then. And so the thing is, you've got your third range boundary. What comes after a third range boundary? Normally, if you're a range trader, nothing, because that's the only trade you're able to take. You would have taken this trade, and end of the story, terminated. Okay? Now, as you're getting toward a trend trading, you're going to be able to do things, which means after the third range boundary comes the fourth one, which means as the prices will retrace to the opposite context, you will be able to do something, which means as you get in here, you get to the fourth range boundary. You're not going to trade it now because you can't, but you're going to have a look at where it is. Where is this third range boundary building itself? Because it can give you multiple answers, but all the trend trading way of thinking is all about what's going to happen at a fourth range boundary. Where are we and what is the structure? So I'm going to giving you like a timetable to follow, a set of rules to follow. As you get to a fourth range boundary, you're going to study where that range is, where the prices currently are. In order to do so, the first question you ask is, where am I regarding to the most major highs and low points? The higher time frames, high and low points. In here, as you can see, we're probably 76% Fibonacci retracement. At 76% Fibonacci retracement, you can say that we can still be in a range. So the option is, if this range in here proceeding, I don't know what happens in there, but if what happens previously is not a mature range, then there is a very likely possibility for this to build a new range. Okay? If the range preceding is mature, then what I'm going to be looking at is the accumulation trade. So accumulation trade shows out of a mature range in a bigger mature range. And in that perspective, that's how you get the very likely structure of an accumulation to take place. What is the difference between the accumulation and the range? The difference is in a normal range structure, prices will go to the context. In an accumulation, price will build a shorter range, a shorter time frame range. As you can see, look at the trend channel in here. All right? We do make the four ranges boundaries in here. You do have your four range boundaries in here. Here would have been your typical third range boundary, but on the lower time frame. And you need to practice with your eyes to have a look at what happens within context, which is the bigger time frame trend channel, and the trend channel in here. And that's how you will highlight those potential accumulations. So the fact that in here, what happened previously in here was a mature range. Remember that we had the 2000 bubble bursting in here. So we had a mature range. So odds for this range to keep on going was pretty low. odds for an accumulation to take place were fairly higher. Now, normally, to validate an accumulation, you need to see that underlying 4 range boundary structure on the lower time frame, and these structures must be maturing at the trend channel and not the context. And this is how you differentiate the trends, the accumulations from just ranging typical structures. If this market was ranging, we would have matured this range on the context. The fact that we mature it at the trend channel in here and on specific levels of retracement, this is very important. As you get into this, all right, normally accumulation trades will take place at least 38% Fibonacci retracement. So here is where it should be, right? There you get your 50% and 61, all right? And 76, obviously I'm not really drawing it well, but the minimum retracement is 38%. So if your range has made its maturity on the lower time frame, if you have it retraced at least 38%, but a maximum is 61, and normally we rarely retrace more than 61% on accumulation. If you are dealing with the trend channel and not the context channels, all right, you're in the safe area to consider an accumulation trade, which means you're going to trade your typical third range boundary, but when you'll see the fourth range boundary happening in this specific context, you'll be able to buy it, which means instead of just range trading, you will start trend trading. Okay? The best case scenario is that you take your profits from the third range boundary and you buy with them, so you've got a free stop loss. Okay? That's really, really one way of doing this thing the right way. And what did you just learn in here? In order to trend trade, you need to range fucking trade first. And if you really understand that and how deeply implicating that is, and in the way you perceive trend trading, you're going to have like a revolution. Most people don't really think range trading is important. I just prove you the opposite. Range trading is absolutely necessary to very well manage trend trades. And believe me, that is really true. If you don't get it, then you're probably trend trading, but not the most efficient way of doing it. A trend trade is generally preceded by a range trade, and if you take the range trade, you're going to have an even safer trend trade to follow. So focus on your range trade, and the question you might wonder is, after I took my third range boundary, am I going to have an interesting full range boundary to trade, yes or no? If the answer is yes, then you can try taking an accumulation. Only if your preceding range is mature, if you have retraced at least 38% down to a maximum of 61, and if you're still trading far from the support context, or resistant context in an opposite direction, obviously. And once you take this trade, the goal is validation, obviously just like a normal trade. So you're going to validate in here when you reach to the trend channel, to the opposite trend channel, and the confirmation will be when you get into context back. And this is where you can confirm that an accumulation is taking place. Because in that perspective, you will have made this structure I generally told you about, which is context, trend channel to context, which means you're returning to the resistant context without going to the opposite context in the meantime. And doing this is the typical sign of an accumulation. Okay? And now, as you get me right in here, what do you think has happened in here? It's the exact same thing that happened in here, but on a shorter time frame. Which means in here, if I go daily, oh, sorry, you would have had the exact same thing at play. We need to go real back in time. All right, here we go. What happened in here? Exactly what we've talked about. Oh, actually, not perfectly. It's weird. We didn't reverse the time frame, the context in here. But, I mean, that's too bad. Sometimes the indicators are not perfect. But in here, you would have had the same thing. Retracing 38%. Okay, 38% would have been here, 50% in there, right? So you would have retraced 50% with the two sets of waves, a range not really perfect in here, but here we go, you've got your range. So you would simply have been unable to catch the third range boundary in here. But here is the fourth range boundary, and you could have buy it. So what we've highlighted on the bigger time frame as a potential accumulation in here showed as another potential accumulation on the lower time frame. As you can see, we've rejected out of context and gone from context to context. This is a sign of exactly what I've been talking to you about earlier, multi-layered things. But how do you truly highlight those things if you know how to differentiate a range? When the range is maturing and not looking for the context, that means an accumulation might be at play. In order to be sure that this is a true worth it accumulation, the preceding structure must be mature as well. Or in here and in this specific case, this accumulation in here is a true one and a true good one to trade because the preceding trade might have been an accumulation by itself. So it's accumulating and accumulating and accumulating until you get the actual outburst, which was in here the breakout of this trend line. Okay? So here's how you navigate accumulations, and that is a big, big step ahead if you really understand how this thing works altogether. Okay? Oh, sorry about that. I messed up with my shortcuts. Okay, so now that you've got the accumulation, what is the breakout? Just like we said, if you clearly have signs of accumulation, which we did in here, the breakout will be the structures that breaks out of these structures. The accumulation comes out of a range that comes out of a bigger range. So normally at that stage, you should be able to see trend lines and structures. These same structures we've talked about earlier, like the triangles, the wedges and stuff like that, the stuff that dumb traders are focusing all their attention on, but without contextualizing them. You know that when you see accumulation trades, this is about time to look for the structures and their breakout. In here, the structures was this one. When we had just this trade, the structure was just a trend channel. We had this, two parallel lines. It's as simple as that. We would have built this thing and seen that the market accumulated at the top area, building a wedge and breaking out of it. Here is where we are. You're going to see cycle breakouts most of the time, which is a good sign and fairly good sign that the market is actually pricing in this accumulation and going for the breakout. But at that stage, if you would like to cut prices in areas, this will be trend preparation, trend breakout, and trend confirmation. You never know how long a trend will last. This one was pretty long, but generally the trend confirmation is the shortest one. In a typical trending structure, you will have the range preceding the trend preparation, all right? It's fairly long generally. The trend breakout is a shorter one, and the trend final confirmation is this. In a trend, we spend more times preparing it, like building the range, accumulating, breaking out, and diverging, and final accessing and stuff. This is diverging, all right, and here comes the pullback and the final access, and you're done. Obviously, the amplitude in here is not that, but in terms of time, accumulation is generally a very long time. Ranges are the longest one. Like accumulation is 1/4 of trending ranges, and pullback also can be fairly long. Like pullbacks can be real quick sometime or very long in some others. But all you need to understand is that the breakout area is divided by 3 areas. You've got the moment in which the cycles are breaking, and you've got the moment in which the trend is confirmed, which is when we close significantly higher than the targets. Because remember, you never know if it's going to be a range breakout or a trend breakout until prices have been kept pushing forward after reaching the target. So the breakout is in 3 ways: preparation, breaking cycles, and confirming that the breakout is fairly there. And the way you're going to navigate this thing is going to be having a structure in here as well, okay? Because the thing is that when the breakout shows up, you can take the breakout trade, then you're going to risk limit that trade, all right? You're going to partial profit take or not doing it, but you're going to secure your stop loss and ride the trend afterwards. The best way to do it, to take this breakout trade in here, it's specifically on this candle in here, all right? The breakout rule, I hope you know about it, is when you are breaking cycles and closing on top of the resistance context and the trend channel in the same time. So this candle is the breakout candle. So you could have taken a trade at this candle, but the best case scenario is to have this trade when you have this trade and eventually even this trade on top of it. Because by doing it, you're fairly more confident because you've got an average price that is around here. So you've got an average price that is far away from the breakout level. And in that perspective, even if that ends up being a false signal, you're generally not even going to take a loss. So if you take the accumulation trade, the breakout trade itself is far more easier to navigate. Okay? Now let's get to the other thing. So after this breakout took place, generally comes the divergence phase. The divergence phase is pure and simply because after trending, people will have to profit take. Remember that there is a lot of speculation and hesitation into market pricing, and therefore there are some points in which this imbalance between bulls and bears will start to stop. And when they do, generally takes the form of a divergence, which means losing momentum. If you take the market pace, it goes look like that. All right, the prices have been surging, they're going to pull back a bit and diverge. And when you get this divergence, generally the easiest way to visualize it is the momentum divergence, in which prices are making new highs, higher highs, but the momentum, the underlying strength of prices will not. You will have something like that. And generally you will get lower highs on momentum, because the momentum is the derivative of prices. It's the derivative strength of price. So in that perspective, this is one of the easiest way to visualize a market going to lose some momentum, diverging. You would have a beautiful divergence in here. You would have another one in here. So why didn't the market reverse in here? Simply because a divergence is not necessarily going to build a market top. Certainly not. And even when you get to divergence, the only information you're providing is that you're just losing a little bit of momentum, losing a little bit of strength. The trend is certainly not over at the divergence, because the following system is a pullback, which is a range, generally on the local time frame, sometimes on the lower ones, but it is a temporary assessment of indecision. And then comes the final excess, all right? And then normally another range takes place, okay? So here is how you do things. So the trend divergence is an uncertain way of trading, reason why only professionals can trade the divergences. Everyone else on divergence will simply partial profit take. You don't try to catch the market top. But sometimes professionals will try to take counter-trendy trades in here, which means try short selling the divergence to try taking little bits of profits in here on shorter time frames. But only professionals can do that. You will certainly want to go down this road. In this prospect, you're going to try focusing on, after your typical third range boundary, trying to get the accumulation trade out of your mature range if they end up retracing at least 38%, fail to retrace the context channel, and follow the guidelines, mature range and stuff like that. In that perspective, after trading third range boundaries, try to take the fourth one into a trend following system. As you get the breakout, take the breakout trade in here. And then, as you get to the first divergence, which will be in here and in here, you start locking on your gains. You take, for example, 25 to 50% profit taking, and you wait for the range to build itself. The range is simply retracing to the opposite context or retracing at least 23% Fibonacci. The rule for a pullback is prices need to retrace at least 23%. So let's take an example in here, bottom to top. All right. In here, was this a pullback? No, wasn't, because we haven't retraced 23%. In here, was this a pullback? Yes, we retraced 23%. This one was barely acceptable as a pullback, but I mean, we'll take it as an account. Anyway, we broke the trend channel in here, so the context, so it is truly in here a pullback. So the pullback is this. You need to retrace 23%. The other rule is that you need to go below 50% context. In this example, we clearly even broke the context channel, so which is an even more aggressive context. So here's your pullback. What is a pullback? The pullback is just going to be another range, either on the local time frame, like in here the context channels have been narrowing so big that we managed to navigate this as a major range. Sometimes it's just going to be a range in the shorter time frame, like you will have your resistance context in here, your support context in there, and you just need to dip a toe at the in-between 50%. All right. Otherwise, that's not enough for a pullback. So 23% dipping a toe at least into 50% context to accept a potential pullback. And as you do accept this potential pullback, you're going to say, all right, what happens? I've got my typical third range boundary, the one I know, the one I master. I definitely know how to navigate this one. What's going to come next? Fourth range boundary. So still the same old question, can I do something in a trending context with that fourth range boundary, yes or no? Remember the set of rules, if I have retraced more than 38%, preceded by a mature range, not retraced more than 61, and still far away from the support context, then that's likely sounding like an accumulation potentially trade. In here, that's a different context. Have we retraced at least 23%? Have we retraced no more than 50%? Because pullbacks rarely retrace more than 50%. And if the answer to this question is yes, having a mature range that retraces approximately 23 or approximately 38%, generally we're resonating near, damn it. Alright, sorry about that. It's the usual midday alarm testing system. Anyway, you must be familiar with these ones at that time. So the thing is, following from those rules, in here you've got a likely context for a pullback, which means you're going to trade this fourth range boundary. Always speculative. We never know what's going to come. Sometimes pullback trades will simply not work, just like accumulation trades certainly doesn't work 100% of times. But they do have definitely interesting context as long as you follow those rules. All right. Remember that the pullback can only occur after the breakout. All right. There is a time structure. All right. These ones can't show up if there's not a mature range preceding them. These ones can be valid pullbacks if there's not the accumulation followed by a breakout, followed by a divergence. All right. They really need to be put in context. These trades, when you take them, you know that the trend is nearly maturing because after the pullback only has the final excess. And final excess is just retracing to the context and trying to accelerate. And whenever prices will try to accelerate, normally this is where they won't find enough strength to do it. Though Wall Street is a very particular asset that hasn't been following these guidelines for other reasons in here, but globally this is what you need to understand. And after the final excess, generally a range is taking place and we start all over again this same old structure. All right, building a range, maturing the range, or trading the third range boundary for you, maturing the range, and figuring out where we are. So the thinking process for you is trade your fucking third range boundary. Anytime you see a context favorable for this, just trade it. And when you've made your third range boundary trade, when you profit took that trade, think about where the fourth range boundary is. And if the fourth range boundary is in the resonating area, then ask yourself about what the context is. If you think that the preceding context is a trend, then might be is a breakout, then look for the conditions for a pullback. Same thing, if the overall context is a matured range, then look where we are. If you are still trading with the trend channel and not the context channel, and that you've retraced at least 38%, you know that it starts to resonate in your head, and you would think maybe that is the type of trade I want. There is a final layer of risk management, of course, in here, because the context and the price filtering is never going to be the same and the old and the only structure to risk manage. So price filtering, context assessment, and always signaling. In order to risk limit those trades, you always want to have these blue types of signals. So this is a blue type of signal. This is an acceptable early trend trade. This one as well, but this one is far less effective. This is a better tested signal. I'm not necessarily certain that I'm going to be using this one in the future. All right, in here, obviously, the taking profit structure is acceptable. It's not the best case scenario, but it's acceptable. It means the bears are profit taking, barely retracing 23% Fibonacci, means the imbalance is still fairly there. We still have far less aggressive bears. There are some bears, all right, but still they're far less effective into pricing things. The bulls are still taking it over. So taking profit is a valid pattern, but the best case scenario is to have those things. In trending context, those blue signals are really good signs of strength and trend fully being in. All right. Now, in order to globalize these things, we're going to be talking about trends in general, right? Not just the structures and stuff like that. So we need to understand that some markets will have natural trends. So let's take a little bit of moment in here trying to explain, like, for example, why does the stock market has an upward trend all the time? Why is the general structures of stock market to the upside? For many reasons, because you need to understand what the assets you're trading is. Like, if you're trading a stock is basically the stock prices represent how much shares of this stock circulating, all right, the supply of shares, and on the same time the demand, how many people want to buy these assets, and also the company's behavior. Is the company making profits, yes or no? What is the profit curve? What is the expected PE ratio? So many stuff. Just like what we said previously for indices, there is going to be speculation, there is going to be supply and demand, buyers and sellers pressures, and there is going to be the reality, what is actually what this company is actually doing. When we look at stock indices, we look at a bunch of assets, a bunch of stocks. So you need to understand what you're looking at. For example, in the SPX, you're looking at the 500 biggest companies in the US. They approximately weigh for 85% of the US GDP. So 95% of what is produced in the US is produced by those 500 companies. So this is something that is pretty broad-based, multi-sectoral. So it is a very well-weighted index. That's the reason why we always use the SPX as the reference for the health of the economical situation in the US. But you've got other assets like the US Dow Jones, the US 30, which means this one is just the 30 biggest and most profitable company and the biggest companies in the US. So how do you think the Dow Jones can eventually even be bearish someday? That's not even a possibility, because you're just taking the 30 best ones making the GDP in the US. How can this be bearish? When someone is losing ground, just like General Electric lately, for example, you're taken down, you're taken off, and someone is going to replace you. So you're always taking the best ones. So for sure, Dow Jones is forever going to be a bullish asset because of its underlying fucking structure. All right? You really understand that? At least I hope so. And now we're going to be talking about Forex. I also generally tell you that Forex is a big range. Forex is always a big range into the bigger time frame for another reason, because in here we're talking about monetary basis. How much money circulates in an economy? All right? So dollars, how many dollars circulating, how many euros, how many stuff like that. And we're going to have relative price strength regarding of how much currency is circulating. So in here we're using monetary base and though inflation, and we're using the strength of the economies underlying these monetary basis. So it's not just about how much dollar circulates, it's how much dollar circulates and how strong is the US economy. How much euro circulates and how strong is the euro economy are the major pillars for a Forex pricing. But the thing is that in here, you're never going to have one country overwhelming every other and having the strongest currency. So that's exactly what the US are thinking about them right now. They're thinking that they're the strongest and they're thinking that no one can take them down. Let me tell you for sure that they're probably wrong, because one of them is certainly not going to be true. You can't have the strongest currency and be the strongest economy on earth, or you can be, but you can be temporarily, because this is all about cycles, and cycles rarely align for a long time. So we've had a nice alignment for the US for decades. I think this is over, just because China has been changing a lot of things recently. China is nowadays the biggest country, and at least it's going to be. And obviously that means the beautiful dollar supremacy, I don't think it's going to last longer. So at least one of those cycles is going to break. Either the US will lose the leadership of that world, or either the dollar will have significant problems. But I can hardly stress that enough. We're not going to have both for an unlimited amount of times, because that's not how economic works, and that's not how anything works and not market works. Because in terms of Forex in any way, it's all about balance, because you can't be the strongest and have the strongest currency forever. It's always oscillating, so it's a matter of relative strength. That's the reason why things are always changing. Currency bases, how much money you create, how strong is your economy, all these things are oscillating through time. That's the reason why there is no trends in Forex. There are short-term trends that can go up to daily, weekly charts at some point, but there will never be monthly trends, because you can't have longer term trends on Forex simply because of those reasons, because it's the combination of the monetary base and the strength of an economy. These things will oscillate. At some point, some economies will be very weak and they will be printing so much money that their currency will like crash. But at some point, when something just can't go down forever, like I said, it's all about balance of power, worldwide based. And at some point, when you're the weakest, you can only grow yourself better. Let me take that as an example, but that's exactly what it is. What that is. You can't be strong forever, just like you can't be weak forever. It's all a matter of cycles. And that's the reason why generally anticipations on Forex means that when you're really the weakest on board, some people might be speculating that you're not going to go worse. And that is one of the many reasons why monetary bases and the way the world is built today, with import-export, a globalized currency system and stuff like that, that makes the whole thing absolutely impossible for trends to last longer than they can, because those big macro cycles in here are just as indecisive as they can, and you're never going to have long-term control. US have been managing to do it for quite some time, but I tend to believe that this era will sooner or later get to an end. When I say sooner or later, I'm talking about monthly or quarterly charts in here, so it can take multiple quarters to actually set in motion. But the US dollar dominations we've had, I think, will not last forever. Anyway, so ranges on Forex, uptrends on stock market indices, because the way they are built is meant to go up, whether you like it or not, and especially the Dow Jones. And now we could talk about cryptocurrencies. What do you think about that? Then cryptocurrencies underlying structures, the assets is a cryptocurrency versus something. What we look at generally is like BTC versus USD. So it's these currencies versus fiat currencies, all right? And in that perspective, we talk about limited supply. Like in here, the problem with cryptocurrencies is that the cryptocurrency has a limited supply. For Bitcoin, we already have a number for this. We know that there will never ever be more than 21 million Bitcoin circulating. So that's the limited inflation of Bitcoin facing something that has an unlimited amount of monetary base. Basically, there can be as many dollars as we want circulating. And we expect that there will be more in the future. So there is an out-of-control inflationary base in the US dollar and a limited controlled inflation on Bitcoin. So in that perspective, yes, this thing can only go up at one reason. Did we just explain that the prices were moving just because of supply and demand? No, of course not. Prices are moving because of supply and demand, how they balance and unbalance. We're talking about the economies. So in terms of Bitcoins, there is no economy underlying it because it's a global currency. So there is no problem with the economy in here. But still, God damn it, that leaves us two big errors. The speculation and hesitation and the multi-time frame layer. So the problem with Bitcoin is that we're dealing with multi-time frame layer, we're dealing with a shit ton of speculators, and there is a lot of hesitation on the reality, on the future for these things. So this is why Bitcoin is very uncertain, not because of its limited supply. That's something that is for sure benefiting the upside, but it's not just about it. Are we really going to have demand for this thing? Supply and demand. The supply is definitely on favor for Bitcoin prices to go up. But is there still going to be a demand a few years from now? Who knows? And until then, we have to deal with speculation and hesitation. And that is the problem with cryptocurrencies. Otherwise, we will have an inevitable uptrend. The problem is we're not yet sure that these things will still be demanded in the future. That's the reason why we hesitate. That's the reason why we're currently ranging in cryptocurrencies. But if we get out of those ranges to the upside, that means the demand is still as strong, the supply is still limited, the supply in the US dollar is still increasing, which means more dollars, less Bitcoins, higher prices for Bitcoins. Simple as that. But that requires a rising or at least a constant demand, and that requires speculation to work its way out of ranges and hesitations. Okay? So anyway, that's going to be it for today. So I really hope that you understand now that those processes of multi-layer, all right, of trying to force your mind to navigate multi-time frame, because it's going to be actually absolutely essential to be a good trend trader. That's the reason why there is a trend channel and a context channels on the indicators to help you having that vision naturally. You need to be double time frame reading for trend trading. That's absolutely necessary. And if you want to be real good and real profitable at trend trading, you will even go 3 time frames. Let me explain. So for example, in this weekly time frame chart in here, beautiful trend, and all right, we're not going to dispute that obviously. The thing is that when you want to navigate a weekly trend, you're generally going to take the daily ranges as reference. Remember that in this daily range, all right, you would take the 4th range boundary to navigate the weekly trend. So to navigate a weekly trend, most of the time you're going to deal with daily. And it's not most of the time, all the time. Like the trend trades will generally be taken in the weekly chart, but the breakout trade. The breakout trade, no one. This one is taken out of the weekly chart. So accumulation trade is taken on the lower time frames. So a weekly accumulation is triggered on the daily chart. But generally trends will be supported by underlying trends, which means in here you can play this game and go on the daily charts, and you would likely find a range in here, a 3rd range boundary, followed by a 4th range that could be a pullback, because it retraced 23% of the big structure on this time frame. All right? Just like you would find eventually no 3rd range boundary in here, because that would be an expanding wedge in here, but you would find a mature 4th range boundary in here, and you would take it as well, which means if you go 2 time frames instead of 1, you can find even more opportunities, because generally trends are underlying shorter term trends. And in that perspective, you can maximize the profits from this. Don't go any way further than that. It really requires a shit ton of experience. But you need to know that one major trend might have rippling effect with underlying short-term trends as well. And you can profit from those underlying short-term trends in the same time. Okay? So that's the final tip and trick in here. Profit from multi-layered time frame trends to be a little bit more aggressive. Obviously, you don't do this when the market is final excess. You always do this in here with the pullback trades. And sometimes you can do it with the accumulation trades. Remember what we've said. We've seen an early accumulation trade in here, and there was another one following in here on the shorter time frame. But once you reach the final excess of the trend, the weekly trend, which was this point and this point, as long as you reach those areas, you get the freaking fuck out. Because at that stage, you're not forecasting the trend to keep on going. If it is keep on going, you know what that is. That is generally a market excess down the road. Not all the trends terminate the way they should. Some trends keep on going to excessive market structures. That's exactly what we've had in the US. This wasn't a normal trend ending. This was an excessive market ending. And we're still dealing with this at the current time. And the volatility we've had recently is just the absolutely normal behavior for a market that has gone excessive. And after excessive, remember that we can still go bubble. So this market can still keep on going up, and it will do, but in a fairly dangerous bubble type of behavior. And if it doesn't, then where do you think we're going to retrace? I personally bet that we'll get there, because that's the last time we left reality. So yeah, I think this is where we're going. Yeah, I don't know how, and I don't know how long it's going to take. I don't know if, but all I can tell is that, yeah, I'm not buying this market until we get to this area. Anyway, that's it for today. That wasn't the goal, but in order to restore trend trades in the US, I personally think that we need to deal with a range. And I think this range is just the ugliest possible way of ranging, which is an expanding wedge structure. So yeah, I'm waiting for at least these prices. I'm waiting for us to break this support. When we'll break it, I think we'll have a decent and more than decent prices to buy. I'm not 100% sure that we'll get there. I will definitely buy those prices, but I don't know if we will get there. And if we don't, then at least I want us to break this context. Okay, so anyway, that's another topic for another day. I hope that today you've been learning those things. Mastering the range is what helps you navigating the structures of trends, because by taking the third range boundary, you're generally going to be able to reinvest the gains of those third range boundary into an hypothetical fourth range boundary that you could be able to trade if they are into some resonating areas. Those resonating areas needs to be well known and mastered if you want to take profit from them. You need to know the rules for an accumulation trade. You need to know the rules for a pullback trade. And if you're new to these things and if you're just getting into trend trading, just make sure that you take the lowest possible leverage. And if you want to get better at trading trends afterwards, the only way to improve your profitability in trends is to use the multi-layer time frame scale. That's the best way of maneuvering through trends without taking much risk and always using the same context. You're using the same rules, you're just using them into a different time frames. All right? That being said, I'm going to leave you guys with that. Next week, we're going to be talking about the psychological problems into trends. What are the psychological biases that might influence with your decision-making process, fool you into changing your mindset, changing your sets of rules and whatever. See you guys next week.